Hey everyone, welcome back to Corporate 2Coder, where we break down the financial statements of big companies, and today we're diving into BioSig Technologies Inc., a company that's making some interesting moves in the medical technology space, but their latest report reads more like a thrilling, albeit slightly scary, financial adventure. We've got some big acquisition news, some eye-watering stock-based compensation, and a whole lot of uncertainty to unpack, so buckle up, and if you appreciate getting straight insights from these complex filings, make sure you're subscribed. We also have a Discord community linked in the description below if you want to chat more about these filings. This is BioSig's quarterly report for June 30, 2025, and it's a bit of a roller coaster. They've got a new CEO, a major acquisition, and by the look of some of these numbers, they're burning through cash pretty fast. Let's see what's really going on behind the scenes. First, the balance sheet. It's like looking at a snapshot of the company's financial health on June 30th. Total assets have ballooned to over $109 million. Now, that sounds good, but a massive chunk of that, nearly $58 million, is goodwill from a recent acquisition. And then there's this other intangible assets number, almost $48 million. These are essentially the value of things you can't touch, like patents or special technology, but they can be tricky to value. On the flip side, their cash position is only about $2.8 million. That's not a lot for a company with these kinds of numbers, especially considering their liabilities, which are over $113 million. A huge part of that is something called a derivative liability, which is over $105 million. This usually means they have some complex financial agreements that are constantly changing in value. Now let's jump to the income statement, the part that shows if they're making money or losing it. For the 3 months ending June 30th, they lost about $20.4 million. And for the first 6 months of the year, that loss jumped to over $23 million. That's a lot of red ink. What's really striking is their revenue. For the 3 months ending June 30th, revenue was practically zero, just $13. Yeah, you heard that right, $13. And for the 6 months ending June 30th, it was a whole $27. This is a major red flag. It means they aren't generating almost any sales from their core business. And look at their operating expenses, general and administrative expenses for the 3 months were nearly $20 million. And for the 6 months, it was over $22 million. A huge chunk of that is stock-based compensation, which basically means they're paying employees and executives with company stock instead of cash. We're talking over $12 million in stock compensation for just 3 months. That's a significant amount. This stock-based compensation is a huge part of their general and administrative expenses, making up over 60% of it in the recent period. This is often a strategy for companies that are short on cash to attract and retain talent. But it also means that the value of those awards depends heavily on the fluctuating price of their stock. To try and keep afloat, they raised over $3.8 million in the 6 months through what's called an at-the-market offering. This is essentially selling their own stock on the open market. It's a way to get cash, but it can also dilute the value of existing shares. Now, that acquisition we mentioned earlier, StreamX Exchange Corporation, that happened on May 28th, and it brought in over $57 million in goodwill. Goodwill is the excess amount paid for a company doesn't perform as expected, leading to write-downs. The acquisition also added over $5 million in intangible assets like trade names and developed technology, but the company is also carrying these as liabilities in the tune of over $105 million, a derivative liability stemming from some complex share exchange agreements related to the StreamX deal. And the result of all this, their net loss per share for the 6 months ended June 30th, 2025 was a negative 95 cents. That's a big number, especially when you consider last year's loss per share was only negative 65 cents. It shows they're losing more money per share than before. This goodwill of nearly $58 million from the StreamX acquisition is a huge part of their assets. But given the company's current financial situation and the fact that StreamX is still in development and pre-revenue, it makes you wonder if this goodwill will hold its value. And here's a really concerning part. The company admits to serious problems with their internal controls. They've identified multiple material weaknesses in their financial reporting. This includes not properly accounting for stock-based compensation, weak review processes for financial disclosures, and poor segregation of duties. Essentially, they're saying their internal checks and balances aren't strong enough, which can lead to errors in their financial reporting. Looking ahead, the company is banking on some big financing deals, like a potential $100 million convertible debenture deal with Yorkville and a whopping $1 billion standby equity purchase agreement. These are massive amounts of money, but they also come with significant strings attached and depend on shareholder approval. It shows how desperate they are for cash. The biggest takeaway here is that BioSig Technologies is in a precarious financial position. They're spending a lot of money, especially on acquisitions and stock-based compensation, but they're barely generating any revenue. The fact that they're admitting to material weaknesses in their internal controls is also a serious concern for investors. While the acquisition of Streamex could be a growth driver, it's a very high-risk bet given the company's current financial reality. It feels like they're building a very expensive house on shaky ground. The massive jump in general and administrative costs, largely due to stock compensation acquisition fees, combined with near-zero revenue, paints a picture of a company that's investing heavily for future growth, but is far from profitable. The market is clearly not impressed with their stock price lightly reflecting these significant concerns. Alright, that's our breakdown of BioSig Technologies' latest filing. What's your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description. Thanks for watching. See you next time.